Good morning and welcome to Charting the Markets on Tuesday, the 14th of February. All eyes are riveted on US consumer price inflation today, and this data comes out at 1:30 p.m. GMT time, and we expect US inflation to come in at 0.3% month on month and 0.4% with regards to core inflation. On a year-on-year basis, we expect to see 6.3% versus a 6.5% reading in the previous month. Now, a much stronger inflation reading could see the dollar rise rapidly and stocks fall back as expectations for the Fed's terminal rate are revised higher. Conversely, inflation growth weakening could lead to investors basically being for a lookout for a further fall in US dollar and some further upside in stocks, following on from yesterday's gains. Now, yesterday we saw European and also US equities rise as geopolitical tensions over the recent US balloon shoot-downs were eased by news that the US Secretary of State was considering meeting a key Chinese diplomat in Munich this week. Investors also became more optimistic about European growth after the European Commission said that the Eurozone would narrowly avoid a recession due to the easing of the energy crisis. Now, in the UK, the unemployment rate this morning remained unchanged for the 3 months to December of 2022 at 3.7% and in line with expectations. But the number of people in work in the UK rose by 74,000 in the 3 months to December, well above market forecasts of about 40,000, and following an increase by 27,000 in December. And also job vacancies fell for the 7th consecutive quarter. So all of this has had an interesting impact on the FTSE 100 chart. And if we look at this daily financial bet here, we can see that we have now risen to a new all-time high, taking us very close to the psychological 8,000 mark. But what is interesting also is that the rise to new all-time highs has so far still not been accompanied by a higher reading in the relative strength index at the bottom of my chart here, which is actually showing a lower high, and that means we have got negative divergence taking us into this all-important US inflation data number out later today. So it'll be interesting to see whether the FTSE 100 fails around the 8,000 mark and then comes off again. But for this wedge pattern here to actually become a negative pattern, what we would have to see first of all is a fall through the November to February uptrend line at 7,885, and then more importantly a fall through the last reactive low. And this was made basically on Friday of last week, when we made a lower low on the candle here compared to the candle on Monday and to the candle on the previous day on Thursday. So that basically comes in at 7,850. So what I'm saying is, for this negative divergence and for this potential wedge pattern to form into a bearish reversal, we would have to fall through 7,850 on the FTSE 100 and close below there ideally, in which case we could see a pretty sharp decline very rapidly towards the January lows, the late January lows, that is at 7,708 and lower. But as long as that doesn't happen, we actually still see a series of higher highs and higher lows on this daily FTSE chart, and it would mean that once we rise above 8,000, the next upside target really is around the 8,050 mark, but there isn't really much with regards to upside targets as we're trading new all-time highs. With regards to the German market, the DAX 40, which we can see here, is interesting because it also is forming negative divergence. Last week's high at 15,656 was basically accompanied by this negative divergence on the daily RSI at the bottom of my chart, and it led to a sell-off back down to 15,245. But since then, we have basically rallied back with regards to the DAX 40 and may retest the breached January to February uptrend line, which is now a resistance line at 15,528. before today's CPI data is out. Now, if we were to manage to rise and to continue to rise and head back above 15,656, then the way would be opened for the psychological 16,000 mark to be reached in the days and weeks ahead. If the CPI data in the States today were to disappoint, though, and if we were to fall through the lows seen last week and also this week between 15,272 and 245, then it is very likely that we would rapidly be heading back down again towards the mid to late January lows between 14,992 and 14,904. So that's really the key support area going forward for the DAX, because if we were to fall through 14,904 on a daily chart closing basis, we would be forming a major reversal pattern on this daily chart. But so far, we are still trading sideways above this key support area, and we'll have to see what the US inflation data brings later out today. Moving on to the US markets, so you can see here the picture is quite similar with regards to the Nasdaq 100. And as we can see here, the Nasdaq 100 daily financial bet recently failed, that is to say at the beginning of February, around the high seen back in September of last year, 12,902. We went to 12,896 on this daily financial bet, and since then have retested the January to February uptrend line, which we bounced back from yesterday, as you can see here. Now, what is interesting on this chart is that it does look as if we are just seeing an ABC zigzag correction. If that is the case, and if we remain above yesterday's low at 12,203 on the Nasdaq 100, then it would mean that the odds are that we could actually rise above this 12,896 to 12,902 area, taking us back higher towards the late August highs at 13,206. So that would be the next upside target in case of further upside to be seen. If US inflation data were to disappoint today, though, where if we were to fall through this week, last week's on Friday low at 12,203, then the odds are pretty high that we have formed some sort of top formation here, which would then take us back down towards the 200-day simply moving average at 11,890 and probably much lower. So really interesting times ahead. But you can basically, from a technical perspective, stay long as you remain above last week's low at 12,203 on this Nasdaq 100 daily financial bet. Now, the US dollar has had an interesting time of late as well. And it will also obviously be influenced by the CPI data out today at 1:30 p.m. London GMT time. But if you look at the US dollar basket, what is interesting here is that on the daily financial bet, we have been testing for the whole of last week this key resistance area made up of the December lows between 103.08 and 103.66. And we did manage to rise last week to 103.63. But since then have been capped by this resistance area and seem to be coming off it again. So from a technical perspective, as long as we stay below 103.66, the height of that resistance area, the downtrend is still intact because we see a series of lower highs and also a series of lower lows, even though we've seen short-term a bounce back from the low seen earlier in February at 101.57. Now, for the downside to gain traction, what we need to see today is to fall through last Thursday's low at 102.32. So if we were to fall through 102.32, then we would most likely fall back towards this breached downtrend line, which now becomes a support line, and that takes us all the way back down again towards 101 or so. So we'll have to see what happens there. But if we were to have an upside surprise, have strong CPI data come out, stronger than expected that is, in the US today, then that could definitely boost the US dollar again, and that could then take us above this key resistance area at 103.66, a daily chart close above which would mean that we would most likely be heading back up again towards the January high at 105.37 and also the 200-day simple moving average at 106.18. So really important, this US CPI reading later today. And the inverse is true for euro-dollar, because euro-dollar makes up 57.6% of the US dollar basket, and therefore you can see more or less the inverse of what you just looked at. And we can see here that yesterday we dropped down to a 6-week low at 106.56, but then recovered and are currently testing previous resistance area, which is now, because of inverse polarity, support, and this basically comes in between 107.15 and 107.90. So this previous support area, sorry, I was just going to say actually it becomes resistance because of the inverse here. So now this resistance area basically goes all the way back up to 107.90, and as long as it caps the top we formed recently at 110.33 is likely still in place, and we could actually slide in case of a fall through 106.56 being seen all the way back down again towards this key support area here, seen between 104.84 and 104.44, made up of the mid-November high and the early January lows. So interesting times ahead, because as long as we stay below 107.90, the downside pressure should retain the upper hand. But if we were to break above 107.90, then most likely we will then head back up again towards the late January highs around 109.29 and then in the 110 area with regards to euro-dollar. Another chart which is interesting is euro sterling, because as you can see here on the daily financial bet, we've now had 7 consecutive days of lower prices on this currency pair, and we are testing this key December to February uptrend line currently, and we'll have to see whether we can hold there later today or not. If not, it is likely that we will be sliding all the way down to the 9th of January low at 87.69, probably also back to down towards the January low at 87.22. And for a bullish reversal to take shape here, we would have to rise above yesterday's high at 88.74. But right now you can see we're just testing this key support area, and we'll have to see whether that holds later on today. Another interesting chart is the British pound against the US dollar cable. And what we've seen here is also a retest of a 3-month support line, which held yesterday, and then we formed this bullish engulfing pattern, completely engulfing Friday's day, which was bearish, and basically taking us to above the high seen last Thursday at 121.94. Now we have to see whether after today's CPI reading in the US we can manage to close above 121.94, because if we do, the way is open for us to head all the way back up again towards the December and January highs at 124.46 to 48. So that would be quite positive for the British pound. But if the US dollar were to slip again, that's the bullish scenario I just talked about. But if the US dollar were to rise again, then we could have cable perhaps retest this uptrend line, and also yesterday's low at 120.31, which a fall through, which would take us back down towards 119.62, the current February low, and also the 200-day simple moving average. So again, a chart to watch out for with regards to the US CPI data later out today. Commodities have also been quite volatile of late, and I'd like to have a look first of all at the price of WTI, US crude. And as we can see here, the oil price stopped its Friday advance on expectations that returning volumes will compensate for the reduced Russian output. And as we can see here, we failed marginally below this key resistance area made up of the mid-October low and the high seen since December, basically between $81.33 and $83.30. And basically since mid-November, we've been trading sideways between, on the upside around $83 and on the downside around $70. So right now it's interesting to see whether we can once again come off this key resistance area and head back down again towards the $70.50 zone and perhaps even lower, or whether this time around will be different and we can rally above the December high at $83.30, in which case we would be forming a major reversal pattern, which could then take us back up again towards not only the red line here, the 200-day simple moving average at $89.92, but also towards the October and November highs between $92.70 and 95 cents. So also from a technical perspective, very interesting, this chart on WTI. And with regards to gold, the gold price basically has been sliding from its 9-month high at $1,959 over the last 2 weeks. Volatility has decreased, but nonetheless we keep on sliding, and so far we've slid to $1,851 per troy ounce on this daily financial bed. And if we were to slide further today, we would have a downside target basically between $1,833 and $10, which are all the highs made up of the early and late December highs basically. So that would be our next support area, $1,833 to 10. And if that were to give way, we could actually slip through the $1,800 mark and slide back down towards the 200-day simple moving average, $1,776. So we'll have to see whether that will be the case with regards to the US CPI data later out today or not. For the bulls to be back in control with regards to the oil price, we really have to rise above last week's high at $1,890. Only then would we have some sort of reversal taking shape here. Now I'd like to finish up on the daily copper price here, because you can see copper has been coming off over the last few weeks as well. It made a multi-month high at $9,951 per ton, but has then dropped back down towards the early February low at $8,809, and since then has been trying to hold there. And yesterday we bounced off that low again, and currently, as you can see here, we're testing the downtrend line. It's only a short-term downtrend line of about 2 weeks or so, but if that were to be broken through, and if a rise above last week's high at $9,064 were to be seen, then the medium-term uptrend will probably have resumed, taking us back up again towards the highs seen in mid-January, $9,951. So that's one scenario. If, however, we were to slide through $8,809, the low seen in early February, we would then be heading back down again towards the November to February uptrend line, which currently can be seen around $8,720, and most likely also retest the November and December highs between $8,629 and $8,593. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.